Cool. Thanks for having me. So yeah, we did this kind of talk comes. I'm just trying to figure out how I click. I guess I do that right. All right, cool. That's my company, so less about that. I'm not talking about that today. But this kind of talk came about a bit of, you know, when you're standing in the morning in the shower and you're just thinking, what is life? This is basically what life is in a weird way. It's a constant minimization of energy, and this comes from me from a physics perspective. Everything is going to a lower energy path, and the reason this is relevant because in crypto, what a lot of people do is they try and force the river up the hill. And you can't force a river up the hill before you build a gap in the hill for the river to go down. And another way of looking at this is taking a popular topic of like DeFi Lego. I think that was a phrase used a couple of years ago. You can't build something unless, I've lost a slide somewhere. Oh, whatever. There was one with Morpheus from the Matrix, which has kind of vanished somewhere. But there's a quote from Morpheus in the Matrix basically saying that you can't get something in a different order from the order that it is supposed to be in. And the only reason I actually had Morpheus in there is because I just really like the Matrix. So he's not so relevant. Oh, there it is. I don't know how that suddenly came up, but that's the one. So the idea is that with DeFi Lego, you can't create something unless you have the Lego block underneath it to create the thing on top. It's like trying to build a Jenga tower without the bottom with the Jenga pieces. And so there's a lot of things in TradFi and in DeFi which can't be created unless we've created the primary steps before them. The difficulty is figuring out which they are. Now, we actually did a load of, after I got out of the shower, I went on to Python. This is back in the day before vibe coding existed, so this actually took a really long time. It's actually depressing how long this took compared to how long it could take today. But what you actually realize is that everything actually comes in a very specific order. And so in terms of like the TradFi kind of ecosystem, we started at currencies, then you have kind of credit and banking primitives. And you can see that Ethereum and Bitcoin come in terms of currencies, right? And then you have banking systems start to be created, MakerDAO. Then you have kind of the corporate credit bonds start to be created. That's kind of like how Aave A tokens are. They allow transferable bond structures. I've highlighted a few kind of gray areas here because what's really interesting in crypto is that we've constantly been kneecapped pretty much every 6 months, is that something random comes in and just like takes the ground out from underneath us. So there's a few pauses which kind of attributed to things like tariffs, or COVID's a fun one, and Choke Point 2 is even funner for the crypto industry. So what we get after kind of like banking, we come into capital markets, so Uniswap, custody of the assets on Uniswap Fireblocks. Then we get derivatives and synthetics. And now the really interesting one, which I would pause on, is Ondo, Athena, and Pendle. I think Athena's been mentioned already today. But the reason I think these are extremely important ones to like highlight is because those actually weren't in my initial analysis of this stuff. And what was really interesting is that we thought about what is next in terms of, like in kind of mid-2024, this is when we did this. And in mid-2024, the next thing that made the most sense was something that's analogous to Eurodollars. So just for those of you who aren't familiar with what Eurodollars are, basically dollars are technically one of the only short-term government bonds that you can buy outside the country of issuance. And so when you call it Eurodollars, it's basically that you can access short-term government debt from the US outside of the US. And the reason that is so extremely important for crypto and some of the systems that we build is that when it comes to issuing a stablecoin, you need to create something underneath it that is extremely trustworthy and stable. And the liquidity of the Eurodollar market is pretty much the main reason you see on chain there is 99.9% US dollars, because no matter how much the US government tried to stop it, you could just buy these short-term government debt instruments all over outside of the US. The difference with the GBP or EUR is you cannot buy these short-term debt instruments unless you're sitting with a counterparty in Europe, or sitting with a counterparty like, say, NatWest or Barclays in London. And as soon as you're doing that, you require a license, and they're not going to give you a trading license for doing that kind of activity. So this is why it's really interesting to look at Eurodollar comparison. because then we get activities like Athena and Pendle coming out of that. And that was something that was actually quite unexpected here. Off the back of Eurodollars, and one more pause on Eurodollars actually, there was a New York Times article I picked up earlier today, and in fact a number of them around the 1965 to 1975 period, which were criticizing Eurodollars for financial stability. They were saying that there's a risk to financial stability of Europe. The other articles were saying that it's going to be used by con artists and scammers. And frankly, you could take all of the things that people have been saying about crypto stablecoins, and then you can find a 1970s to 1960s article criticizing pretty much exactly the same things in Eurodollar terms. So that's why I find this particularly interesting. So what's next in this particular timeline? What building blocks get built upon the initial ground in the next kind of, and also where are we? I think this is the point of the talk, right? We're stuck in the 1970s. We're at the point where we have the explosion of Eurodollars. We have the explosion of fixed income. The very start of fixed income in TradFi was around 1950s, 1960s, more around 1960s, when something called treasury stripping happened. It became really, really popular. Treasury stripping is Pendle, effectively. And if you've been alive in the last year, you realize Pendle's had a pretty good run for it. The other thing which is interesting is consumer credit, and I think a lot of people realize there's been also flagged on a talk earlier today, MetaMask Pay, Gnosis Pay, a few others. All of these kind of like credit card things have been exploding recently. So the next phase of this is ALM, asset liability management. That's where banks like to trade on their customer deposits. Fixed income, particularly things like swaps. Lots of people have tried to build swaps in the past in DeFi, but again, it hasn't really been the right time. The next thing is like trust, compliance, and governance. And I think this is something that Vinci was talking about, particularly on the trust. We're all just fed up of getting hacked, frankly. I'm fed up of it. I think a lot of other people are fed up of it. And I think we want some adults in the room to kind of like start managing these processes and protocols. And then there's the explosion in consumer credit, which we're actually starting to see right now. So who's doing this? Asset liability management. I love this project that's come out recently called Infinify. I don't know if anybody's heard of that one. A good friend of mine called Rob is running that one. And I think it's the first ALM project. We're doing the kind of the trust, compliance, and governance stuff, tooting our own horn there on my own slides, why not? Fixed income, Morpho V2, bringing out fixed income for the first time in DeFi lending and borrowing primitives. I think that's really exciting. Pendle, obviously, they're doing innovative stuff still. And then there was another one which came out recently, which I added only in the last couple of weeks, which is consumer credit. So Klarna just did a massive announcement in the last month or so about consumer credit, and Stable also in the same way. So I'm just going to start focusing on trust, compliance, and governance to start with. Now, this is a controversial statement. So Vitalik has been talking about low-risk DeFi. I don't think it exists at all. And the reason it doesn't exist, because if you follow the money just disagrees with you. If you talk to any major L1 treasuries and say, now this is a contentious BD point. If you work at a protocol that is on any of these L1s and you ask them for money, you will get shown the door pretty quickly. They'll say to you, do you want incentives? You'll give you fantastic support all across the board, but they won't give you US dollars, not in any kind of meaningful capacity. And the reality is why would they nuke their entire project for your small protocol? That's the problem of it. So when it comes to solving that, we need transparency, governance, oversight, and ultimately insurance being the holy grail here. So in terms of transparency, what's being done here, there is a big kind of move from the industry to come together and create a DeFi Capital Standards Association. So this is basically a cross-industry, multi-year effort, effectively to bring in something like, for those of you who are familiar with traditional finance, is basically akin to the Basel standards and FRTB, Fundamental Review of the Trading Book. So what will happen here is all of these protocols, hedge funds, providers are going to start supporting something that looks like a transparency standard and reporting standard for DeFi lending and borrowing, particularly on the credit aspect. And I think this will expand to other areas. So effectively, this mimics what happened in 1984, which is where ISDA was created and started doing the same thing in TradFi. The second thing is oversight. So I don't know if anybody's ever been in a legal dispute with any other startup or crypto company, but it's an absolute nightmare because they don't have any money. So it's like when you sign an MNDA with people that you know in the room, right? It's utterly pointless because what are you going to do? Sue them for 50 quid. So what happens when these guys come in, like JP, Brevin, Apollo, Citadel, Nomura, is they have a lot more than $50. So when they do sign an MNDA or they do screw someone over, they've got significant business lines at risk. Took a good example is Brevin Howard have something like $40 billion in fixed income. They've got $2 billion in crypto. Interestingly, their $2 billion in crypto gave them almost all of their returns, which were better than all of the other hedge funds in the last year. But as a result of that, they're extremely cautious in how they act in the crypto industry. They're not going to break stuff in production. Apollo, for example, when you deal with them, they're extremely touchy about what you do. Even if you're like 3 steps away from Apollo, they will have a huge amount of control over what goes on because the brand, even the third degree association of how you use their products. And that's really important when it comes to people who are going to be managing assets for their kids' school fees or your retirement fund. You don't want to just YOLO it into, I don't know, some random coin on pump fund and then it disappears. A really good example of this is actually, ironically, MakerDAO Sky, who they did quite a successful rebrand. But I was talking to a hedge fund recently who asked me if we had any lending and borrowing markets that would work for Maker. I said, do you mean Sky? And they said, no, Maker. And I said, you got a lot of Maker? And they said, yeah, we got a shitload of Maker. And I was like, guys, you really want to shift that? And they were like, why? I said, if you've not been alive recently, they're going to inflate that to nothing. And suddenly there was a scurry of trading activity in that fund when they realized that they had actually been losing an absolute ton of money by not moving these assets over. And that's a good example of where you can accidentally get rugged by something which is not even really scammy, but it's just a sign of maturity of the ecosystem. So finally, insurance. Insurance is the really interesting one, and of the low-risk DeFi post from Vitalik, this was the one that I actually thought this was a killer chart. It shows that DeFi is incredibly insurable. Now, if I have to guesstimate, and I've actually been quite involved in underwriting efforts recently and helping, so my background's a quant, so do the mathematical modeling and stuff in finance, so it's been quite, there's been a lot of interest from we're doing stuff in insurance at the moment, and the insurers are very interested in the underwriting side of that, and I think the fair value of DeFi insurance is approximately around about 50 to 75 basis points, even if you're including the commercial spread. Because when you look here at DeFi losses as a fraction of the L1 TVL, it's a very diversifying trade. If you get hacked on Aave, it's not suddenly crime is legal and Morpho goes down as well as Euler. It's very, very orthogonal risks to each other. And so the question is where is the capital? Now, there's a lot of capital available in the system, particularly available for this kind of activity. Restaking something, Symbiotic team have a good presence in Lisbon, so shout out to these guys. Restaking something they're looking at the moment. Eigenlayer as well are also looking at this. Idle L1s, that's not Idle the protocol, as Idle L1s is in like Ripple and Stellar. There's a team called Centaura who we're good friends with who have just brought out a fantastic thing where they're using idle assets on those L1s to backstop risks in DeFi. Mutuals like Nexus Mutual, the OGs in crypto insurance, still going strong and they're actually working with most of the above. And then the holy grail is regulated insurance. If we can get the underwriters over the line with regulated insurance, the golden chalice is basically Lloyd's of London. If you can get that, that's a home run. And the star specific circumstances. Now, I'll just take a slight pause here to talk about how many people own a house in the room or a flat. Put your hand up. So quite a few. And I'm assuming you have home insurance for your house in case it gets robbed or burned down. Now, if you went to your, I would like to see a show of hands of how many people would go to their insurer and try and get home insurance if they had no front door. I mean, it would be a difficult ask, right? It's going to NatWest Bank or going to Millennium or whoever it might be and saying, hi, I have no door lock or front door and anybody can come in, but can you please insure the contents of my house? Because I live in Uerdish or I live in Lisbon. It's actually pretty safe. They would probably tell you to get lost or charge you an absolute ton of money. And that's exactly what's happening at the moment in crypto insurance, because the issue we have right now is that they just will not give capacity of insurance for unpermissioned DeFi. And the big issue is that people haven't been able to figure out a way to permission DeFi in a way that doesn't involve, I mean, imagine if your house, you have the option of going into changing your front door lock to say, I need to do a screen of a KYC every time you go into your house and forget your keys. That's a disaster. And that's why it hasn't happened in DeFi. Because if I'm being honest, I would far rather have no front door than give my passport to a random startup every time I have to get into my home and my wife isn't there. As it turns out, I do have to do KYC because I always forget my keys and my cleaner has to check it's me. But that's an easy KYC. So the second topic which I want to spend a couple of minutes on is fixed income. And this is the area which I think is going to be the one that really rips with the first part. Now, I take a kind of a slight curveball here. Why is this related to fixed income? Why is this lineage related to fixed income? What does fixed income have to do with this? Basically, I mean, I've given you the spoiler there, actually, accidentally, to be honest with you. But effectively, decentralization happens when you bring apart regulated markets. You've got Tether, 20 billion ARR, disrupting banking licenses. You've got Polymarket, 9 billion valuation, disrupting gambling licenses. You've got Hyperliquid, broker-dealer licenses, disrupting that for around about $1 to $2 billion this year in revenue. The interesting thing is fixed income and where it's used. Fixed income is a cornerstone of the asset management industry, and if you take to anybody from a retail banking mindset, a gambling or a broker-dealer mindset, the one business that they all want to get into is asset management. Asset management is extremely lucrative, and it's one of the biggest businesses in finance. And the cornerstone of asset management is fixed income. Now, one of the really interesting things here is that we have very, very little fixed income, particularly native issuance fixed income in DeFi right now. And I think one of the things that Benji was talking about, which I'm really excited for, is L1 and L2 starting to issue pensions natively. Because I think the point where we have pension funds on-chain, in on-chain assets, is the explosive and critical component where we start moving into an extremely mature system, and we have the fully transparent, verifiable, and mathematically consistent financial system that's self-contained. I think we're actually quite a long way away from that because we all need to start having kids who graduated from school to care about pensions. But I think that's definitely the whole. That's where things are moving. But interestingly, the data shows that fixed income, nevertheless, is exploding on chain. Now, if you heard the word curator this year, that's very much in vogue. And it's because the reason it's in vogue is because it didn't exist just over a year and a half ago. Even in 2023, at the end of 23, early 24, the AUM and I say AUM kind of like blase, TVL, whatever. There's no regulators here, who cares? 2024 Q1, it was absolutely zero. This has exploded to $7.5 billion. And what's really interesting, I don't know if I've got a laser here. No, it doesn't work, whatever. If you look at the point where I've done the prediction, we're actually following the bull case because I actually truncated this at the end of Q3 last year. We've actually added another $2.5 billion to curated TVL in the last couple of months. I think that was actually solely in December. And so we are aggressively following that red line up. And what's really exciting about this is the kind of like what you call in like VC world, the serviceable accessible market of curated TVL. But when you look at the actual like full market or the total accessible market, you should really include Aave in this. And if you include Aave in this, you add a zero to all of these numbers. Because, I mean, let's be honest, Aave are killing it, but it's a huge, huge market. And Aave are also seeing that same exponential increase. So the summary here is if you look at all of the things that form 1980s in TradFi, we are coming aggressively into the 1980s. Trust, governance, and oversight. This is something that Benji was talking about as well. Trust, governance, and oversight. It's going to be critical in the next couple of years. Decentralized asset management is going to stand on the shoulders of fixed income. Fixed income is coming. Shoulder pads are optional. I think I might get a shirt like Gordon Gekko. So thank you very much. Do I go this way?